Welcome to the Modern CPA Success Show, the podcast dedicated to helping accounting firms stay ahead of the curve. Our mission is to provide you with the latest and greatest insights on cutting-edge tools, innovative marketing strategies, virtual CFO services, and alternative billing methods. Join us as we change the way people think about accounting.
And in this episode we have today, I think we're bringing people a little bit of education and also a resource they can really take advantage of. What were your thoughts?
Well, first of all, it's about tax, which never really gets me super excited. I'll be honest with you. But it's the second part of that, tax savings. The savings part does, and I think Dave is a great resource. I think for anybody listening, and I think it really is a great complement to what we do for our clients. That we need to know a little bit about stuff, and then be able to position subject matter experts in. So I was super excited to talk to him.
Yeah, me too. And he simplified it, and really early on he gives us specific sort of some numbers about here's who would qualify well for these plans. That to me had me immediately thinking, yep, this client yes, this client no for sure. So absolutely. I hope people will get the same thing out of it. Hope they love it.
Yeah, I think they will.
Another episode of the Modern CPA Success Show. I'm Tom Waddleton. I'm one of the virtual CFOs at Summit Virtual CFO by Anders. Joined by my usual co-host Adam Hale. Adam, welcome.
Hey, Tom.
And we are excited today to have Dave Podell. Dave is the founder of Business Benefit Consultants. Dave, welcome. And I would love, if you don't mind, starting just kind of the story of your career and what brought you to us today.
Yeah, so I started 20 years ago as a financial advisor, kind of recreated throughout that time. We still have a separate advisory firm. I would say close to 10 years ago, got into this very specific niche of defined benefit, cash balance, large deductible tax strategy realm. As an advisor back then, I had the opportunity to do one or two of these cases with clients, realized at the time when I was trying to get this information that every plan design was different from the next. I also found out at the time that I wasn't getting answers to the questions that I needed. And when I was getting answers, I found out there were a million different options. And I said, if I could figure all this out, puzzle it, we can create a great consulting company around it. And decided to go to create this consulting company, go straight down that niche. And now we educate and work solely with tax advisors and also some financial advisors.
Mm-hmm.
Exciting stuff. So I know everybody's on the edge of their seat. We're talking tax, but this is the fun part of tax, because this is the savings. It's tax savings. And I think that it's also important that, even for, the people that maybe are watching this and saying, hey, I can't even spell tax. I don't want to do tax. I think it's really important. We talk about this all the time as CFOs. We're not supposed to be everything to everyone. However, we should know people that know just about everything. So it's really, for us, we try to build kind of a Rolodex of folks and resources for our clients. So whether that's attorneys or like these and because the reality is like, there's a lot of stuff that we can do or we know a little bit about to be dangerous, but whenever it's time to really step into that arena, you want somebody that's what they do all day long. And so Dave, that is you, and that is where like we should know enough, and hopefully we'll be able to gain enough information today to be a little bit dangerous, to be able to introduce the topic, to be able to qualify which clients would work for this kind of thing. And then of course then we can say, and we know Dave. And so happy to make that introduction with you, client. I think that's really kind of the purpose. And I think that if you are listening to this and you are looking to be a VCFO or you are a VCFO, it's really important just to kind of have that context out in a lot of different spaces, not just in this one particular one. So.
Yeah, I agree. And timing wise, as you mentioned, Adam, so we do tax for our clients. I don't personally consider myself a tax expert. At the same time, it is so common when you get to this time of the year, especially when someone owes taxes, that they'll come back and say, hey, shouldn't you be doing more to help me save on taxes? This is a really big check that I've written to the IRS. And so to give a couple of ideas, but if they say that one sounds really good, cash balance plan, something like that, I don't have the skill to help them implement. doing that. So
Yeah, and Dave, we've got some questions for you just right off the gate, because a lot of times, and again, just to make a distinction between tax planning and tax projections, we do a lot of tax projections. I am not totally in love with tax planning a lot of times, because it's the same, people are always like, oh, they're not doing enough tax planning for me. I'm like, well, because there's really like the same 15 or 20 big things to do. And, like, I don't want to put your kid on the website, you know what I mean, and give them a $2,000 wage. There's just a bunch of low hanging stuff. But the reason why I'm excited today is because we're talking about the big ticket items. Now, in order to be in the big ticket item game, obviously it's going to require cash. You know what I mean? So the business has to be throwing off profits. We've got to be able to do these kind of things. So that's qualifying point now. But I mean, whenever we're talking about defined benefit plans and cash balance plans, set us up. What does an ideal client look like?
Yeah, so good points. I mean, these plans are they add tremendous benefit from a tax saving standpoint, as well as an owner who is maybe behind in their retirement plan and where they want to be. As we know, most businesses, especially small businesses, the biggest part of their net worth is in the business. Maybe they have a 401, maybe they have profit sharing or SEP or some other plan. But this is a way for them to put a significant amount of money away and take a big deduction. So they're putting that money away on a pre-tax basis. And most of the way these plans get set up, most of that benefit is geared toward the owner or partners for the taxpayer. Obviously, we do have to cover employees if there's employees. Generally, when these plans are combined, and that's why there's all these different designs, the owner and partners are getting the largest portion of that benefit. We generally see anywhere between 85 to 100% going to an ownership. You had asked about who's ideal. Well, yes, there's got to be profits. There has to be cash. A good mark that I will often use and explain to people is, if you can put away $100,000 or more, this is worth looking into. If it's less than that, you're probably fine with what I will call on-the-shelf traditional 401, maybe profit sharing type plan. There is complexities to this. There's resources that have to be put together. But I will tell you, we do plenty plans where people are putting away between $500,000 and $1 million. We even have plans above $1 million where they're putting that kind of money away and getting those deductions and not paying taxes on those dollars at this point.
Okay, I got a lot of questions on that one. So, so I get it, $100,000. You got to be willing to part ways with that, for a period of time. Maybe this is kind of going too far down the road just yet, but do people then, they don't have access to that money, right? So that's going to be in a traditional, so it's not like they're going to be able to loan against that money or do something, reinvest. Because again, to your point, like a lot of times the business is their number one asset. It's throwing off cash. They're spending it just as fast as they're getting it. And then of course the taxes hit, and that's a big dip for them. But when this money goes into this tax savings vehicle, it is kind of locked down until retirement is kind of the intent.
Yep. And that's why we do see now we have recently gotten a lot of plans from some younger clients in late 20s, early 30s. But generally, we see a lot of these plans, people in their 50s. And the reason is because they've gotten to a point where the business it's seasoned. They're comfortable with profits, they're comfortable with what they're taking. It's grown, and they just want to be able to pay less in taxes and put away more for themselves. This allows them to do it on a pre-tax basis. Yes, the money is away till 60, like a traditional retirement plan. Where those assets go, generally, and there's a lot to this, but they can go in many different areas. We've been asked about private equity, real estate, alternatives, certain things that people do not want to put traditional money in the market. There are ways to direct funds to those areas. There's a lot of caveats and details to that, but the funds can be put in there. So somebody who, we get a lot of, I'm investing only in real estate, I only want to be in real estate. they do have that ability. But again, the money is tied up till retirement. It's a retirement plan like a 401, and that's why you're getting such a big benefit for it.
Elevate your firm with a virtual CFO playbook, how to land $60,000 per year clients and provide a killer client experience. This comprehensive online series of modules provides you with the essential tools to create and deliver scalable VCFO services. Developed from Summit's successful approach, which propelled them from $500,000 to over $10 million in revenue in 10 years. This playbook will equip you with the skills to take your firm to the next level. Additionally, upon completion, you can receive 24 hours of CPE credit for the course. Ready to grow your firm? Enroll now at vcfoplaybook.summitcpa.net.
Okay. And you mentioned the 100,000. So let me just cue on that for 1 second. So if I have a business that, like many businesses, 1 year throws off 200,000, the next year it loses money, the next year it's something else. Is there an additional qualification of fairly consistent? You have to stay in the game at a certain level, or is it such that you could say, I can contribute 1 year and turn around the next year and say it's a very different amount and maybe even zero?
Yeah, great question. So we only look at designs and work with actuarial designs that are flexible. So because that's going to be the biggest question, that's going to be anyone's objection is, if I can put $100,000 away this year, next year I want to know, can I go to zero or can I go to 300,000? And the answer is yes, there is the flexibility. We just need throughout the year to be in touch with how that client is doing and what they might want to do for a target funding of the next year. We have set up plans where someone had a great year. They want to do a plan for 3 years. They had a great year. They want to put in a huge amount of money, but the next 2 or 3 years, they want to put in zero. There are ways in the designs, and that's why this is not an on-the-shelf type product. And it's not like, well, 401, we have these limits. I can put away X amount of dollars and it goes in here. Generally, these plans are combined with a profit sharing bucket as well as a 401 bucket. So anyone listening to this is saying, well, I have a 401. What do I do here? We try to leave that 401 alone. We don't want to disrupt what's in place, but we do want to work around it. It does need to get tested with everything else. We work with about 15 different actuarial designs around the country. One's very different from the next. So we're trying to find out what is the objective and then how can we get the best possible contribution. I want to just give an example because I think that would help on how different these things are. We just had a plan where we went to one actuary who said, I can get max, this person was very young, I could get max $100,000 in this plan. Went to another one, they had totally different design, everything was different. They were at 140,000, couldn't do anything else. We went to a third design and it was 250,000. So these are completely different from the next. And a lot of times people have gone to an actuary, gone to a TPA, they'll get something back. We see this a lot. And they're like, it doesn't work. I'm only getting 88%, 93%. I don't want to give anything to employees, or I can't get enough in there. We will sometimes look at that, go to a different type of design, and you could find a completely different answer, and they're shocked.
That's what I was going to ask, is because I think sometimes the hesitation too is like, cool, I can put $250,000 away. Oh, but what you mean is I get 175 of that, and 75,000 is going to my other team that I already compensate and give bonuses and all this other stuff and do 401k match for. It's like then all of a sudden some people are okay with it, some aren't. I know Tom specifically, and we'll talk offline about the specific client here that we might want to introduce to Dave, but yes. I remember specifically one client that we had at like a 92% rate, right? Like everything was going to him. He only had like 3 or 4 employees, and we're like, hey, this is really cool. And then all of a sudden, like, he had switched people or something. He'd switched brokers or whoever he was dealing with. And I remember like a year or two later, I just happened to be checking in with the CFO at the time. This is pre you, Tom. And I was like, wow, there's an awful lot of money going to these other 3 pretty low waged people. And I'm like, this seems really weird. This is not what I remember. And again, it's plan design. It's whoever's kind of doing that. So to your point, it sounds like there's a lot of you have the ability behind the scenes, maybe, as opposed to like if you go to one broker dealer or somebody that says, hey, this is who I'm using. It sounds like you're kind of operating, whereas more you have like a variety of different people. So if you know the objective is to maximize the owner's contribution portion, you can kind of toy around with a couple different design layouts to be able to do that, to be able to maximize that along with the amount that they can put away. Is that
Yeah,
fair?
we're also operating in a space that I don't see anyone else operating in, because if if somebody has a financial advisor, they can use that advisor. We're happy to. We're not coming from this of our benefit is in assets or products or solutions. We're coming from a consulting standpoint. So we will go work. Often we'll get referred by a CPA to a client or a financial advisor from a financial advisor. We'll get referred to the client. We're going through all this, and then when it comes down to where those funds are going, well, you have a relationship, great. We're going to talk to that person and help them set up the account they're going to manage the money. Where you had brought up, broker dealers in different places. We're not coming at this from an investment advisory side. This is on a consulting basis. So we're getting paid independently, like the TPA. We package all the resources together, so it's very simple and easy for the client and the tax advisor to understand. And then we're mapping out who does what and who's getting paid for what.
That is atypical. I mean, the majority of it is like, obviously there's a lot in the initial design and that kind of piece, but there is always that assets under management kind of aspect of it that you typically see. So that's pretty cool if you're kind of independent in terms of your fees as far as the design goes, similar to a TPA. What is that, since we're on the subject there, what does that typically look like from a fee perspective? Because that's the other piece sometimes with some of these larger scale plans. I'm thinking of like insurance captives, for instance. Insurance captives, similar kind of a thing, like, hey, you can put away a ton of money. There's some obvious other risks associated with it. You do have to kind of continually stay at a certain pace, but there's big fees associated with doing an insurance captive. How does the fee structure kind of work?
These are a lot of resources involved, but the actual fees and costs to set these things up and do them are not significant compared to what those benefits actually are. So just for example, and this is a range, but on like a solo plan, I can give you an example of a large one, a doctor who $700,000 is going away. Solo plan. Plan is very detailed. There's a lot of stuff that's going on in there to be able to get that kind of money away. But I think the total fee that he is paying on that is around $4,000 to set it up and $4,000 every year.
Gotcha. Okay.
Sounds great.
And that includes us, TPA, kind of everything that's
okay. I thought maybe that was just your aspect.
That's not just us. No, that's kind of now if he had, let's just take that same person and let's just say he had 15 employees or 10 employees. He's probably going to be between $6,000 and $8,000.
To your point, though, that's nowhere close to what I'm talking about when it relates to like doing a captive insurance for instance. So that's
to speak to kind of compare on some other strategies like a captive or anything else that's out there. I always explain, like, this is something that's been around forever. This is not something like captive, and not to say anything negative about it, but that it could be looked at or a problem with. You're using a enrolled actuary. It's getting tested every year. There's a lot of compliance. Things are getting filed, and we're also there every year. We're involved in this to make these plans successful. We're not just on setting it up and disappear. We're very involved in coordinating of resources, gathering documents every year, making sure the compliance work is getting done properly, all that stuff, making sure we're getting statements and details that we need from the advisor, the tax professional involved. these plans, a lot of times I've heard in the past when I started this is, oh, I had that, it didn't work, or there was such a problem with it, or, it blew up, whatever it was. And I realized in every case, it was no one talks to each other. It's impossible to coordinate a TPA, actuary, advisor, consultant, tax person, like record keeper, all that together, unless someone's doing that. And that's where we come in.
Okay, so you're kind of quarterbacking that whole thing. On the structure side of things, like no, I mean, obviously I know it depends if it's solo or whatever, but LLC versus S Corp versus C Corp, no conflicts there with any entity type.
They all work as long as income is pensionable. So, for example, if you only have real estate, passive income coming in, it's not going to work. Where in those cases we've seen tax advisors will go there. A lot of times there's a management company, and then it works if they're pulling something out from a possible management company. The structure of the company, it's irrelevant, but we need income. So if you're an S corp and you're taking a W-2 of $50,000 and want to get a whole bunch of money in a plan, a lot of times we're going to come back and say that's got to go up to 100. The W-2, what that wage is, it is part of the calculation on what that contribution is. Now, we will try to work with what's there, but if someone's looking for a bigger deduction, a bigger contribution into the plan, then we might oftentimes need to increase that wage that owner is taking.
Yeah, I'm sure you can kind of counterbalance the additional, FICA tax and show again the value there after tax savings and everything like that, and then tell them, of course, they're going to get a bigger Social Security check. They should be excited.
Yeah.
What about just kind of switching gears there? What about like M&A money? So, do you find that defined benefit plans or cash balance plans work with if a client is having an exit? Is that a good strategy to like do a one-time dump into a bunch of, or is that not effective? They've got a lot of cash coming off and they're just like, hey, what do I do with this? I got a lot of tax. Is there something I can do with this? Are either of those an option?
So the answer is yes. These plans can be set up and then they can be funded with certain dollar amounts. Plans could then sometimes be moved to a different entity. We do find an owner if they get bought out. They often have like an LLC where they're listed as a consultant and still getting income from. But I will give you two examples that we went through in the last, I would say, year and a half with private equity fund buying out is maximizing owners putting in the maximum amounts they possibly can into these plans because it becomes an add back in the valuation. So they're increasing the value of the business when they're getting it ready or it's being looked at because it's showing that if an owner's putting away or partners are putting away an extra $500,000 and they're getting 90% plus of that, it's almost like showing like the owners could, like who's ever buying it, they could pull out additional money.
Sure.
If that wasn't there. Yeah.
Owner add back for sure. But in terms of like, does it make sense, like, especially if it's structured with heavy capital gains treatment, does it make sense to do either one of these plans, or is it still typically if there's like a big depreciation recapture or ordinary income? How does that?
So we want to always look at that we have to look at each situation because if there's capital gains taxes that are going to be paid and those are going to be a lower rate than, getting ordinary income in the future, then it might not make sense, right? We want to figure out the lowest. One of the things when I'm always speaking on this, I'll always say that with these plans, you control the recognition of when you want to pay the taxes, right? We're putting money in a plan and you're putting profits away. You're not recognizing it now. Yes, you're going to pay those taxes in the future when you pull money out, which there are other things that can be done around that, that we've worked with the advisors on in doing so, whether it's Roth conversions once the plan is shut down. There's some other features and ways to pull money out of the plan on a tax-free basis that get a little bit more complicated, but there are ways of doing it, and also depending on the design. So you're putting money in right now when you're getting taxed the most on the business that you have. The other thing I want to also bring up is these plans should be in place for around 3 to 5 years. The IRS does not want, these big deductions and plans put in place and then shut down a year later. It doesn't mean you need to fund at the same dollar amounts, but that plan should be open and kept open for around those 3 to 5 years. Now, a lot of times, depending on the age, someone's keeping it even longer. It's going really into retirement and putting significant money away. Sometimes it's somebody that's older and maybe they're going to sell in a few years. Maybe they're going to retire. Maybe they're going to pass it on to a child or somebody else that's in the business or a partner. So, but you want to have that plan open for those 3 to 5 years.
Yeah, okay. That makes sense. I mean, event aside, but I guess one big piece that we probably skipped over, like just thinking about, I think we've kind of cornered like who the ideal client is, but what we didn't really talk about when we started, Tom, was we were like, hey, we just need to know enough to be dangerous, right? To be able to introduce it.
Sure.
Explain it to me like I'm a fifth grader. What's the difference between a defined benefit plan and a cash balance plan?
Before I do that, as a fifth grader, I'll tell you a 401k, you could put in a certain amount of money and you might be or might not be maxing it, right? Think about this as being able to put away 3 times, 5 times, 10 times that dollar amount.
Mm-hmm.
So think about if your 401k, instead of allowing you to put in $20,000 to $30,000, would allow you to put away $200,000, $300,000. That's the best way of thinking about how these work in simple terms. It's also going to unlock a whole bunch of tax advantages from the standpoint of, get qualifying for QBI or bringing you into a lower bracket. You're removing this income or profits off. Cash balance versus defined benefit. They look and feel very much the same. They're really 2 different names, 2 different formulas, but they do very similar things. As a fifth grader, I will explain that defined benefit, we look at and see the most in designs on solo plans. Cash balance, we need to get a little bit more creative based on all the different designs to get more money to the owner. So cash balance, in a very simplistic terms, helps increase that percentage to owners when there's other employees we need to test with. This is not always the case. There's a design that we like to use where we don't even need to put employees in the defined benefit plan. They can get offset and taken care of in the profit sharing bucket, and then we only keep the owners in the defined benefit plan. So it's a little bit more of a generous contribution and profit sharing for the employees, but it still tests well enough to make the owners get the higher benefit. And that's the key here. It's efficiency. Are we getting the 80, 90, 98% benefit to the taxpayer and using maybe a 401 as an actual benefit to the employees? This is more an employer benefit than it is an employee.
Okay.
Gotcha.
So Dave, if I was talking to a client, getting these 2 and knowing how similar they are, it sounds like my response to a client that wants to do more, and there's an opportunity to say, there are these 2 things we should consider with these high deductible plans. I don't think I'm qualified to say, it sounds for you, defined benefit is the one you want to go after. Let's call Dave and see if he can help us. Is that right? We'd be saying, let's go and figure out what works best for you. Because between the 2 maybe doesn't matter. And I probably don't need to know enough to be able to say it's one of these or the other.
No, this is what you need to know is does the client, do they have additional profits, additional money that they want to put away? And do they not need those funds and want to pay less taxes? If they want to pay less taxes and they're willing to part with additional money, then we just need to get you, we need the information. We have a link, and there's an intake form with questions. It's very simple, should take about a minute, some census information, and then we'll come back and say, okay, we want to learn a little bit more from you about the client before we go in and to an actual design. And then we will look at a few different designs to figure out what's best fitting. And
Okay.
then we make it we turn it into something that's very simple.
Let me make sure if I can play that back. If I think I've got a client where this works, it sounds like I give you some information initially. We have discussion or exchange things in email. You're telling me what you think is possible, and then we can pull the client in, and you're a little bit prepped for that. It's not just a hand the client off to you and say,
oh
"Let's see
yeah,
what
yeah,
works
it's
here."
totally,
I like
yes, it's totally, you're fully involved. It's
that.
not, we don't want a client actually hand it off to us, because it's a lot easier to go back to you and ask certain questions that they don't know anyway. But yeah, you're fully involved. Now, we do get some referrals where the tax advisor just knows this is going to work, knows, they're in good hands, and they just
Mhm.
send us names, but
Sure.
we're still keeping that person involved throughout everything, because throughout the year, we still need to know details about the business. Are we going to lower the W-2 because we want to put in less? That will help the funding go down too. Um, do we need to raise it because we're going to put in more? How does everything else everything is connected and corresponds, and it just needs to be done and quarterbacked, and that's what we do.
Okay.
Yeah.
I'm curious why more people don't know about this. Why do you think
Tell
these are?
you.
And maybe they're more prevalent than I know, but I'd love to know why this isn't maybe more common knowledge.
I'll tell you two reasons that I see. There's a lot of resources involved. There's complexity.
Mm.
And because of that, people don't know where to go for it. We have seen a lot of situations where they go directly to a TPA or an actuary, and that's fine. And sometimes those plans really work out well, and they have those plans and everything is great. But they don't know what they don't know. So there might be a better plan out there, or a better design for them or their company, that they just now don't know. The other reason is because financial advisors who do know that these things exist, they know that there's also complexities,
Mm.
and it is a lot of work. And if you're not solely specific to it and fully involved in it, you wind up dealing with all the issues and not understanding certain things because it's not your main focus on what you do, where an advisor, their main focus is advising and managing money.
Yeah, and from our perspective, I mean, what I think, and this will probably resonate with a lot of people that are helping clients out with the financial side. Of course they're frustrated. They're like, why do I owe so much money in tax? Like,
Yep.
oh, it's because you made $1 million. I made a what? And it's like, so they don't even realize they made $1 million, and then whenever you walk them through like where it went, well, yeah, 400 of that went to taxes. You took the other 600. Remember the Ferrari you bought? Remember the boat you bought? Remember the, the extra money you had to take, that you forget about. And so whenever it comes to the questions, like, yes, I can save you money. The question just is, are you willing to part with it? Are you willing to park
Yeah.
it somewhere and not touch it? Are you willing not to buy the extra house, not to buy the extra cars? And to your point, I think that whenever people are 20, 30, and maybe early 40s, they're still like young families and they're still in the height of spending. And then, then all of a sudden they get into like mid to late 40s or 50s and they're like, I haven't even really been maxing out that little 401k that I have. I
Yes.
probably should be thinking bigger, longer term. And so those conversations have a tendency to come full circle. They don't have those early pieces. But again, even whenever you kind of go to them from a financial advisor perspective, like you said, a lot of times people are like, well, I have a contact in my broker dealer, and they're not getting the, I liken it a lot to going to an Allstate insurance agent, right? Like, so you go to, no offense to Allstate, but like you go to an Allstate insurance agent, you're only going to get Allstate insurance. Whereas if you go to a broker that has access to 15 AAA different insurance companies, they can kind of find the best fit for you and find the best, you know what I mean? So I think even whenever people do get exposed to it, even if they get past that first, like, oh, big money and I can't play with it, Yep, nope, it goes away. Okay, I guess. And then whenever they see the design, and if the design falls flat, and like I said, 25% of it goes to their team, they're just like, well, that's not kind of what I was thinking either. You know what I mean?
Mhm.
So I think those are a lot of the big obstacles. So I think having a resource like you, Dave, that people can go to, like from kind of like that consulting broker relationship where you have all these abilities to play out all these different options and custom fit it for the client. I think that's a huge resource. And this is exactly what we're talking about whenever we talk to our CFOs. Know a little bit to be dangerous, know it exists, and know a little bit about it so you can kind of help qualify the client, get them prepared for the opportunity. And then you say, and I got a guy. So I'm going to call Dave. I'll run some numbers. We'll get back, I'll get his take on it, and then we'll get back to you and set something up. That's typically how I handle all my client relationships with a variety of different things. And I think this is a great example of that.
Mhm.
Yeah, it's a huge value piece that is not being brought up, and the main reason is, and it's such a good question. The main reason is because somebody doesn't have a trusted resource that they know specializes in doing this. I have heard, a lot of times someone will go to an actuary, they'll use that, then they'll, try to send more clients there, and that's kind of the only thing that I've heard outside from us getting business from doing these things and meeting more people and speaking to them. Our Like I said, our benefit is we can use your advisor. Your advisor can be fully involved in taking those assets and managing those funds. If you're doing things on your own and you don't have an advisor because you don't want somebody, there's a way, or to do that as well. What I will bring up, the defined benefit plans, these are not meant to, those assets are not supposed to go and get 10, 15, 20% stock market type returns. The 401 portion is good
Hmm.
for that. Defined benefit is a safer bucket. It's you're getting a, and I'll always say, you're getting 30 or 40% on your money to begin with,
Sure.
depending on your tax bracket, just by putting it in this box. But there's a crediting rate of around 5% every year that you're getting on your funds. And the investments really need to keep up with that. So you're looking for a moderate return, not something that's going to go, anything that gets 10, 15% can lose 10 or 15%. And that can mess with the funding. So that's why we're kind of in touch with the advisors or whoever is actually managing that money, whether it's the owner or their advisor, on, this is where those assets should probably be from a risk standpoint.
You can vary the risk, is what you're saying, but typically you're typically so there's
You
not
want to,
restrictions there per se, but you're just saying your advice typically is to make them more conservative.
right, conservative, yeah, moderately conservative, I would say, because you want to keep up with these, with these, with the crediting rate of that number.
Right. And you're typically dealing with people closer to retirement anyway, so it's not like they're wanting to roll the dice on penny stocks and small
Yeah.
cap foreign, all that kind of stuff. So the more
And you can do
nominal
all
stuff.
that with the 401. You could even, if you're a solo, you could even do it with the profit sharing funds. But on the DB side, what you don't want to happen is you don't want to have too much money. You don't want to go and make 30% every year for a few years, and now this plan is overfunded. Just like you don't want to
Mm.
lose all that, and then the actuary is going, "Hey, you can't put money in again. I know you want deduction, but you're stuck, and you got a
Okay.
problem because you put assets in this plan that were high flying."
That's good to know in that design.
Yeah, that
You
is.
know, as Adam mentioned, us having tools, one of the things that we've started doing with our client, not for the very first time, but as we're doing tax planning, our tax director has a list of 15, 20 different tax strategies. And they can run from small, like employing your children or the accountability plan of writing off some home expenses. But he'll mention these to clients. And it's often with clients we've worked with for a long time where we haven't been bringing up things because we think we know them. And here's a good chance to kind of mention things and kind of give an overview and have them say, are they interested? it also can, I think, can help the being reactive with the one who steps off an airplane and says, hey, I read this, 3-paragraph article and I want to go do X. And now you're sort of on your heels reacting to something and saying, what about something else? So I love being able to say certain things, to Adam's point, kind of how are you feeling about your overall retirement? And if you're hearing not very good, and I'm afraid I can't max out my 401k to get me to where I want to be, you've got a great place to say, well, we've got options here. Let's talk about what's possible. And then we understand what they're doing from a cash flow perspective to see if it looks like it's doable to have that conversation with them.
Yeah, and for your listeners, I think it's important for us to talk about timing, right? We can do 2023 plans up until tax filing. So
Okay.
anyone can still get a tax deduction and get these plans set up. As you know, we want to talk about it now, and whether it's April or they're going on extension, but they have time to set them up and to fund for 2023.
Okay.
Now, so unlike a 401k that has to be set up in like October, you're saying this is still.
Yep, we could still get money in there. You could still get money in the profit sharing component. If 401 is even part of the plan, that will be part of 24, but the other portions of this will be the bigger portions, and they could still get a 23 deduction. We're also getting a good inflow of referrals regarding 24 right now, and I love these 24 plans that we're setting up because they don't have to get all the money in there till next year's filing. So that's a long time to be able to hold on to cash flow and do that. We have a lot of CPAs that will go and they'll plan for it for, okay, let's just say it's a $300,000 contribution. They'll plan for it and they will adjust the estimates for the client throughout the year and bring them down based on knowing that they're going to have this bigger deduction. So cash flow wise, they're paying less in estimates, sometimes cutting them in half, and they're directing those funds into the plan, and they can do it on a monthly basis, quarterly. Do I have profits? Do I have cash flow? Do I want to? Yes. Great. Let's put some in. No. Okay. Let's not. They have that flexibility to do it instead of waiting till next filing for, till getting to that deadline and saying, here's a big check.
Okay. And knowing that it could apply to 2023, how long is a typical time frame? Because we love deadlines, and I assume you don't want someone calling you, April 10th and saying, "Can I still get it done by April 15th?" What do you need to know?
We work quick.
When?
It's just everybody else, right? Like it's always, asking the clients for some basic information. It takes time. They disappear after saying yes, and then resurface and say, "Oh, here's everything you needed. Why isn't this set up tomorrow?" So I would say on average, it's around a month that it takes to get it set up. There's a lot involved, a lot of resources, but it can happen within a month. I would say I have, from what I see, it's generally around 6 weeks. Just because of the way that, us getting the information that we need.
But that's enough if someone's finding themselves come to the tax deadline, right? 6 weeks in advance, corporate return should be getting done right around that time where you could be saying, hey, remember we told you you're going to write a big check. Say it's $1 million check. There are some things you can do to try to lower that. We've got to move now if you want to, but we could do that. And you're telling me, yes, you could get that in place in that time.
Yep.
That could be a scenario where someone is. The nice planful one might be, hey, for the last couple of years, looks like you've been doing great. Let's get something in place for a multi-year strategy that you would have.
Yep, both work.
Yeah.
Cool.
This is excellent. I feel like I've got a great tool and a resource that we can refer people over to you. It looks like it's a really easy, seamless way to get people over to talk to you. I didn't hear you say any specific, so kind of any 401k you're willing to work with. Are there many cases where you're coming in saying, okay, you really need to be switching away from an existing kind of?
That's a great question. We're not really trying to switch or move the 401 around. What we might have to do for testing purposes is sometimes change the way the match is being done or the formula on it. We try not to do that. So if it has to get done with a design, we'll sometimes go back to the actuary or go to a different design because nobody wants their match messed with. if there's employees. Like that's a hard conversation to have, unless it's a better match. And sometimes it is. Sometimes it's, well, this is going to be better because it's allowing these other things to work this way. But we do need, a lot of times, if there is a 401 in place, we need the documents behind the scenes of, like, what does the match look like? What does an adoption agreement look like? We'll get to a point, and we try to not ask for too much information up front, because that could take a long time. And by the time we get all that, it's just, we're far down the line. And so we'll try to gather what we can and then work with that and then ask for those documents. But again, we're not trying to disrupt that 401 if we don't have to.
Excellent. Well, Dave, thank you very much. This is helpful. I feel like I've been educated enough that I can talk to my clients and know enough to say, let's bring in the expert to get that done, and then trust how that will go, versus feeling like I have to know every bit of information.
I appreciate it.
Good.
Excellent.
Thanks. Hope everyone has a great day.
Thanks. Take care.
Thanks, guys.
Enjoy this podcast? Visit our website, summitcpa.net, to get more tips and strategy for achieving modern CPA firm success. We're here to be a resource in this ever-changing industry.